Hi, everyone. Thanks for joining us. This is the first experiment on an interview with important protocols in the DeFi space. We're joined today by UMA Protocol, Clayton. Why don't you give us a quick intro on who you are?
Sure. So I am one of those important people from one of those important protocols. My name is Clayton Roche. I'm the head of community at UMA Protocol, and really excited to chat with you, Dorjee, about all things DeFi and synthetic assets and stuff. So thanks for putting this together. Good stuff.
Awesome. No, thank you. And tell us a bit about UMA and maybe a bit about synthetics and synthetic assets and how you guys came into the space.
Sure, absolutely. So UMA is most readily known in the DeFi space for synthetic assets. We have this system of economic guarantees that allows people to launch financial contracts on chain. There's also this other element of UMA, which has to do with this priceless and optimistic oracle, which allows for people to maintain financial contracts without having to push on-chain price feeds. So that's one sort of component. A synthetic asset, it's any asset that tracks the value of another asset without having to have any of that underlying asset in it. I could try to use that sentence without using the word asset so many times, but basically you're able to track the value of something on another market without having to have any of it. So just like a really simple example might be to have something that tracks the value of Tesla without having to actually own Tesla stock through a US broker, for example. So that's like one basic example of a synthetic asset.
And so what's the difference between a crypto synthetic asset versus a traditional finance world asset?
Sure. So synthetic assets in the crypto space, what's interesting about them is cryptos and then DeFi in particular, has these themes of permissionlessness and trustlessness. And the idea is like, if you have a synthetic asset that tracks the value of an asset on another market that might have certain barriers for people to participate in, you're actually able to like allow anyone to access assets that traditionally they couldn't have had access to. So that's really kind of the exciting angle in the crypto space for synthetic asset, is this idea of permissionlessness. So just to kind of go back to that Tesla example, you might think about just the ability for anyone to be able to access the value of that particular stock without having to sign up through a US broker and pay all the middleman fees and everything else. So that's one of the big pieces of it, I think, is that permissionless side. There's just a lot of flexibility there in the crypto space in particular that has to do with tokenizing things that traditionally maybe don't exist in financial markets, or they're just like special combinations.
Yeah, and I think the Tesla example is good, especially, say, for example, in the developing world. You know, if you're a farmer in a country where you might not have access to a Charles Schwab account or some type of limitation in terms of trading, say, equities in the US. But are there any sort of other examples that may be interesting that would give an edge over traditional synthetics? So one of the other issues I was going to ask you about was collateral. So obviously there is a requirement for collateral. You know, how does that kind of interplay? And maybe if there are any examples of where, for whatever reason, they're faster, cheaper, more access that the audience can learn about.
Sure, absolutely. That's a good question. And actually, collateral is a pretty big topic when you consider a synthetic asset, right? Like for people to have a synthetic asset that works, you have to basically have the collateral in common. Meaning like, let's say, Dorjee, you and I want to create a synthetic asset arrangement just between you and I. And we say like, hey, if Tesla goes up, I'll pay you. If it goes down, you pay me. We kind of create a peer-to-peer. It's not really a whole synthetic asset, but you get the idea. Like we've been able to kind of track the value of that asset just between you and I. And what we're using to do that is a collateral, or it's not even collateral at this point since it's just an agreement, but we're going to use a common asset that you and I both value. So maybe it's like Singaporean dollars or US dollars or ETH. So in the case, in the crypto case, like you can use any on-chain collateral typically that has basically some established value. So obviously the Perl token is an example of one that's actually approved on UMA, as is DAI and ETH, and there's a few other ERC compatible collaterals that are on there. And what's exciting about this is basically the ability for different types of collateral to be able to be used that might not be able to get financing with it in the traditional space. So whether that's in the case of Perlin, you know, you have your project's token you can use as collateral. But we could also start talking about collateralizing gold or collateralizing ownership in a startup. Maybe you don't have like enough liquidity to sell all the tokens at once, but you can use them as collateral. There's other flexibilities here with being able to use different collateral types to mint these synthetic assets. So that really does add a dimension to it.
So collateral then links to something which is talked about a lot in DeFi, which is total value lock, so TVL, but it also links to what are the benefits of a crypto synthetic versus a traditional synthetic, where you do have some assets being tied up, but there is more flexibility. So maybe talk a bit about how you see or you're watching the evolution with this concept of TVL. I mean, if you look at DeFi Pulse, there's a lot of discussion in media about how much value collateral is being locked up by DeFi, and then, what the implications of that might be.
So I think that that's a metric that has different implications depending on the protocol. I think it's kind of like a useful proxy for measuring traction of some kind. It's just like something that we can compare protocols against each other. I would say that it doesn't have an obvious correlation to like the value of the protocol or even the value of the related token always, but it's still very much a measure of the success of kind of DeFi, right? Like you're talking about the number of dollars that are locked up in these contracts, which is also a reflection too of the security. If a protocol has 10 million or 100 million or $1 billion locked into it, you can essentially think of that almost like a bug bounty. Like the protocol is offering you this much money if you can break it, which is a funny way of thinking of it. But yeah, it's a good reflection of that. And then, in UMA's case, the kind of correlation between TVL and token value in UMA's case is actually pretty straightforward, just because of the economic design of the governance system in UMA. Basically, for UMA to properly secure the contracts that are launched on it, the market cap of the token has to be twice the TVL in the protocol. It's basically designed explicitly to work that way because it needs to be more expensive to basically bribe token holders to lie than the possible profit from getting them to lie. That's exactly the kind of the economic design of it. So that's in UMA's case, and then just kind of varies project to project.
Yeah, and in protocols which are for lending, having huge amounts of collateral locked up, TVL locked up, the ability to lend more. I mean, we're always seeking mainstream adoption, and that's going to happen with larger amounts. So, crossing the $1 billion TVL for DeFi is a big deal. And I guess that also ties into the concept around APY. So there's been a lot talked about, in terms of like the annual sort of amount of return, how people are kind of estimating yield. And obviously this is a debatable topic, but what are your thoughts on APY? And obviously this year has seen some projects have an enormous APY, like the yield return on some of the short-lived but explosive tokens was in the thousands of percents. But we're now in more of what I would consider a sustainable sort of APY range. What are your thoughts on kind of what you've seen with the link between APY and collateral and the yields?
Sure. Yeah, it's an interesting thing. And even using APY to measure it is kind of funny because you're talking about APY levels that exist for a day or two at a time. And sometimes they exist on a token whose value might like drop to zero at any moment, which is in the yield farming space, they call a rug pull, where like the launcher maybe pulls all the liquidity and so then your tokens are worth nothing. So it's kind of a funny thing that you normally think of APYs in the context of a credit card, and 18% sounds high, or it's your less than 1% bank return, et cetera. Now, as far as like where the market is today, yeah, I would say it's like kind of closer to more reasonable, like double digits are happy. We're no longer looking for triple or quadruple digits as a reflex after the kind of like hype period that we had. It's been interesting in UMA's case. So we're doing liquidity mining. What was really fascinating was to watch basically, like we could calculate how much money we were paying out on a weekly basis just by looking at our token price and then the number of tokens we're paying out. So we got to watch the cost of capital change over time. And so, for example, over the summer when Yam Finance launched and all of a sudden you could get these really high returns, we saw the cost of our capital go way up because suddenly it was more expensive to attract capital, right? Now we're seeing the opposite. So like actually over these last couple of weeks, gradually the amount of money locked in our liquidity mining program has been climbing. It's up over 50 million now, just because the cost of capital across the market has fallen, right? Then the other thing I would say is like, it's really interesting learning from the perspective of like what it takes to attract liquidity, and it depends on the assets, right? Like basically, if you're a liquidity provider, you need to consider both the volatility of the asset you're providing. So if you're a natural holder of that asset already, like maybe someone's a Perl token holder and they're long your project and they want to hold the token, then they don't experience that as price risk per se because they're like a natural holder. But if you bought it specifically to be an LP, then you would have price risk. But then there's also impermanent loss. So that's the loss that can happen when the two assets that you're providing liquidity on, when they change in value relative to each other. And so what we're seeing is like the cost of capital not only changes across the market, but on an asset to asset basis, just depending on kind of the market's preference to hold those assets, as well as their sensitivity to risk and the impermanent loss. I think it's kind of a better time. Like it's good learning time right now. The water's like a little calmer and we can like tease out different variables and understand what's going on a little better right now.
Yeah.
Yeah.
And I think for liquidity providers, a very material risk is the risk of being hacked, because we've seen some very high profile unaudited contracts be exploited. And one of the things that, for example, audited projects like yourselves, like Perlin X, we are actually not wanting to compete on some of the frothy levels of return because we actually shouldn't have to. It should be no different to holding an alt or holding a Zimbabwean rand versus USD. There's different levels of confidence in the infrastructure.
Exactly.
But that kind of brings to the question. So UMA is now pioneering a new form of liquidity mining, shifting into developer mining. Tell us a bit about that and why is that the case?
Yeah, thanks, Dorjee. I'd love to. So yeah, we just recently launched something called developer mining. It's basically the next iteration on top of liquidity mining, but the goal is to reward people for building things rather than just providing capital. And also the goal is to make sure that the protocol is rewarding the people who build on the protocol with ownership in the protocol. It's kind of like making sure that the right people can participate in governance in UMA. So the way that developer mining is going to work is basically we're going to pay out rewards on a weekly basis to developers based on the total value of the synthetic assets that have been minted in their contracts. So if a developer launches a contract, there's kind of a few steps that go into it. They launch the contract, then they also have an interface where people can purchase this synthetic asset. Basically the amount of those assets that are purchased and then also how long they're held over time will impact their percentage of the total rewards that they receive. I could use Perlin as an example.
Yeah.
Perlin launched Perl USD synthetic asset, right? And so you've got people that are minting that asset through your interface, and whatever the percentage of total value has been minted through your interface, or sorry, not even just through your interface, but from your contract. Although I think 100% of it at this point would be through your interface. You'll receive a proportional amount of those rewards. And then what's interesting is we're paying you as the developer. You could just hold on to those UMA tokens because you want UMA tokens, or you can pass them on to your participants as liquidity mining rewards. So what this allows you to do is create your own liquidity mining program. And so you as a developer can decide how much liquidity you need, how you want to direct those rewards, whether it's part of your business model or if it's your way of attracting liquidity, et cetera. So it's really designed to give a little more flexibility and focused on the building side, less than the capital side.
Yeah, and obviously Perlin X, we were the first developer to really implement the UX experience in the front end, and we're big supporters. So for other developers out there, maybe explain how they can contribute to the UMA ecosystem, or what's the value of, say, the work that, say, Perlin X did. Why would you want other developers to do similarly or evolve on that?
Sure. Yeah, and I hope that you can help answer that as well. Like, I hope that you guys have seen value in building it. And I think one of the coolest things that we could see projects do, like yourself, is you were able to offer your users an ability to do financial maneuvers without having to sell the Perl token. Instead, they can use it as a collateral, right? So that's an interesting capability, right? Something that I would suggest for any developer that's interested in doing the developer mining is actually to check out your interface, because UMA is an interesting protocol and it requires a few learnings, and you have to kind of decide how you're going to present these things to users. And you guys have trailblazed a bit here, so like people can kind of come and get some inspiration from the way that you guys have both explained how to operate and presented it to users and things like that. Yeah, totally an awesome job there. Yeah, so that's what I would say. I would say people should start by checking out the way that you guys have done it, and then otherwise, yeah, hop into the like UMA Discord and start just express some interest that you want to participate, and we'll kind of throw resources at you.
Yeah, no, thanks. And Clayton, why we did it, we definitely saw what UMA's doing as being a new way that's more what I would call, Oracle light. We think that you can also spool up synthetics much faster as we improve the UMA process and speed that up. And like we look at, say, the real world. So obviously my history and interest and passion around climate change and carbon trading. So we're looking at a synthetic, PX carbon, just simply because fingers crossed, if there's a change of government, when there's a change of government in the US, we think that climate action is going to become an imperative. But who can trade carbon? Right now, it's energy companies in Europe. But how many people care about climate? Well, Greta Thunberg has several million millennial followers. So how do we get an active market on an asset like carbon? So that's why we're looking at innovative, what I would call long tail alternative, synthetic assets. So just from our perspective, of course, we're very happy to speak to any developer that wants to kind of join and learn and build on this. But yeah, coming back, what would be your goal for the developer mining program, and what are you looking for from developers and community members out there for this next phase of UMA's growth?
Sure. Thanks for that question. Let me just add too, like you mentioned that basically these energy companies are the only ones that can trade the carbon. And like, that's a really great example of a really awesome use case for synthetic assets, right? Like there's kind of this way where synthetic assets can basically say like, no, like you can't block anyone from participating in any of these markets, right? So I think that's pretty cool, just from an ideological standpoint. And plus, of course, the environmental piece from an ideological standpoint as well. That's great. So to answer your question, like what do we want to see developers do? What do we want to see happening with UMA with this developer mining? Basically, UMA is a protocol, and as much as we can, we want to move away from like building products ourselves as the team. Now, of course, like it's kind of a tall order to just sort of put a protocol out there and expect products to spring up. And that's kind of the purpose of the developer mining program is to help incentivize that, to provide the kind of the right nutrients in the soil so that things can start to grow out of the protocol. So what we would love to see is basically people coming and trying out new experiments. The program is really designed to focus on people who come in with new ideas and want to launch a particular idea, and then also like create an interface and get people to participate in that. So we have a few developers that are actually building in stealth right now. They want to keep their idea to themselves for now, and then kind of do a fast launch. And then we also have like a couple partners like yourself. And I would just love to see more and more of that happen. UMA has, like, at the current valuation, the total allocation that we could put towards developer mining is worth around $250 million right now. So like, there's really a lot of firepower here to supercharge this and really grow some projects. So that's really what we'd like to see happen. And in the long run too, like I want to see projects come, build interesting things, and participate in the protocol, participate in governance, get excited about what UMA is doing, and be a part of it. That's really the goal here. Is it's less so about paying people for a job and more about making sure that capital goes to the people who are building in the protocol, so that they become like responsible custodians of the protocol. Because that's really the goal, is to decentralize this capital among the people who are using it and represent it and understand it. And I always think the coolest thing about crypto and building something like a protocol is, I guarantee you that in 3 or 5 years, like the product market fit that UMA finds will probably surprise the heck out of me. Like I have ideas, but I'm guessing that the things that people build that actually take off will probably be something I couldn't even anticipate. That really excites me. That's really what I'd love to see happen.
Yeah, that's a great note to end this first interview on, because exactly like you said, right now everything in crypto and DeFi is just experiment after experiment, and actually, to the carbon synthetic, we'll do another show just on that. So we've got some thoughts. You'll be seeing a UMIP shortly. We're currently in the process of securing price index feeds, etc. So So very excited to continue the conversation. Thank you for joining us, and thanks for the time.
Cool. Thanks, Dorjee. Take care.
Awesome.